of the day. It is the
Thank you.
midweek
Thank you so
point
much indeed.
where
I'm
we will
happy
be
to know
talking.
that you are well.
Yeah, I'm good. I don't know if you can hear me or there's a delay happening at the moment.
Are you able to hear me loud and clear?
Yes, I can. I can actually hear you pretty clearly. Just not sure. Yeah, maybe just I think there's a little bit of a delay or a lag, a little bit of a lag effect happening right now.
Okay. Can I?
Yeah, I hope we're not having that same freeze frame. So I think on the other side of 60 at 60, I'll be able to join you fully to make sure that now we can go through our midweek markets topic. Today we'll be talking, obviously, we'll just be following up on yesterday's news. There are a few announcements, but there's not much happening on the domestic part, but there is a lot happening on the international side of the market. There is a lot of activity starting to pick up on the international side of the market. We're starting to see a lot of the outlooks happening for this year and the global outlooks in general. Then we'll be talking about, remember, we're doing our journey called the Financial Matrix. The Financial Matrix is now where we're going to be trying to help people set up their financial plans and systems for the rest. And we do this every January where we go through the financial matrix. And the first part of the financial matrix we'll be going through today is the 8 levels of wealth, so that you kind of know where you are as a person and what the next stage you need to go to is before we start looking at the structural issues of your financial planning pyramid, your levels of wealth in general, altogether, your investment strategies, and your investment behaviors before we start looking at wealth strategy. But before we start going into any more of that, let's go into 60 at 60, which will be taken on by Vernon, and then I'll be back on the other side. All right, so welcome back to everybody as we now get into the midweek market session. There are a few pieces of news that we want to start looking at in terms of what is going on in the market, and I'll be welcoming back Vernon now, who should be now be joining us for this session. But first, let's get into a deep dive of things. We're still continuing with a loss in the kwacha. When we're looking at the spectrum of spending, I mean, when we're looking at our FX rates, our kwacha is still losing momentum, and it's constantly been in about 65th day. Sorry, it's the 65th day of loss on the currency. Sorry, I just want to get my statements correct. But yes, we are currently still losing a lot of ground on the kwacha, and we haven't really stopped since. So now we're on about 18.34 on the interbank rate. This is one of the worst losses of the kwacha since the record was set in 2021 of 200 days of loss of the kwacha. So this is the second worst on record, and we're continuing to lose on record. When we're looking at the stock market as well, and we're also seeing the same, by the way, with the rand. When we're looking at the stock market this year, we have seen about 0.26% upwards movement on the stock market. A few stocks are readjusting, waiting for earnings season. So that's when we're really going to go through a lot of securities analysis during earnings season, so that we're able to analyze what's been happening to each of these and what are the expectations. I am probably thinking that in the second half of the year, we're probably going to see a bit of a slowdown in some areas, but there is still growing economic strength in the second half of the year. But the outlook for this year, first half of the year, or at least the first quarter of the year, will at least be muddied up by things like load shedding. It will be muddied up by probably inflation pressures building into the economy. So for the first component here, we are seeing a stock market that is flat and a bond market that is still waiting for most of that, is still basically picking up. Now, remember that there is the expectation that next week we shall be going through a bond auction, the first bond auction of the year. And to all bond investors, I always advise you want to make sure that you participate in the first 3 auctions of the year. And the reason you want to do that is personal momentum. Personal momentum gets built up when you start stockpiling your money into the first 3 auctions. So this kind of gets your year going. You don't want to get on the back foot. So you want to get through your learning phases when it comes to bonds and injecting your capital into the bond markets as quickly as possible through this period. But there is something I want to talk about when it comes to bonds and interest rates very quickly as a mild segue to as many people in terms of getting the early parts of this out. One of the concerns that we're facing these days is a lot of people are talking about getting swindled and getting scammed. A lot of people are constantly, you're switching on the news and you're seeing, or you're switching on social media, and there's this person writing a long thesis about why they got scammed and why they got swindled. There's a lot of stories coming out like that, but the common running theme I keep seeing with a lot of these people is that a large majority of their wealth is in these quote unquote so-called scams and swindles. And I'm not here to point out any fingers. I want to help people with a little bit of a preventative measure here. One, your concentration risk of your money sitting in unregulated assets or non-property. So there are two kinds of places where your money should be sitting. The majority of your money should be sitting in 2 places: property and public markets. These are the 2 places your money should be sitting: publicly traded securities or property. This is where the majority, the largest quantum of wealth is kept in this world. And in order to make sure that people are able to manage themselves, you want to have the majority of your money sitting in public markets and property. Now, when we're talking about property, you don't want to be too heavy in property. And the reason why we're saying that people overdo it, we're not saying don't have property. What I'm trying to say is don't overdo it. It's simply because property is usually a bet on the job market. Okay. And if the job market is bad, you usually will see landlords suffering altogether. So you want to diversify in downswings, in job downswings. And Zambia still does not have a very strong labor market to make sure that properties are always outright taken. Some people get lucky and manage to get their properties fully through, but a lot of people have got vacancy risks. So you don't want to be subject to a lot of vacancy risk in your property portfolio or in your full wealth portfolio. So you want to have some public markets. I always tell people 49, 39, the rest can sit in risk instruments. But if you want to have a safe bet, 49, 39 is the portfolio that I've assessed in this country, where 49% of your wealth is sitting in somewhere like bonds or fixed income or dividend stocks. And then the other 39 is then sitting in property. And you want to measure the property according to the metric that we use. We use about 39. When we're measuring property, we use about 39. We use about We take the rent that you get every month and multiply it by 133. That's how we do it in our spectrum internally, because it helps us equate your property to a bond and see what the value is in terms of cash flow, not in terms of speculation and how it's valued. We just get it straight in terms of cash flow because we're looking at its liquidity value. Because it does sometimes become difficult to liquidate a property in a bad market. And we never really take into consideration in the last valuations that were done. And also the sentimental value that's also done in how much a property is purchased for, unlike a stock where the value is actually sitting. But anyway, the point is I wanted you to diversify. Now, when people are putting their money with other people, remember that the main goal of investing is to let other people use your money. And there's various things I want you to go through, okay, when doing this. So I just want to quickly segue to a lesson before we open up to the rest of the global markets. But there are things you should be doing when you let other people use your money. So people, remember the first lesson I want you to remember as you're having trouble with where to put your money is, first, I call this the 4 C's of asset selection. Okay, there are 4 C's of asset selection. And the 4 C's of asset selection are character, credibility, credentials, and consistency. These are 4 things you need to measure a potential investment on, because if you do these 4 things and you make sure that the public component of your portfolio, at least 85% of it, should be sitting in assets that tick these 4 boxes. Because if you've got assets that tick these 4 boxes, most of the time you are managed. So let's go through each of those. The first step is to assess character. Who are these people? Are they good? Are they a good place to keep your money? Are they of sound character? Are they structured? So the first thing you want to do is, inside character, there's what I call the arc of character, which is ARC. You'll see I use a lot of acronyms to make life easy. The arc of character starts with authenticity. Can you authenticate who these people are? Do they have papers? Are they registered? Now, that's not the number one thing only. People like say, we got swindled, these people registered people. That's one component. Okay, I'm about to give you 4 with 3 subcomponents in one. So please take these things through a checklist. If you do this methodically, you can avoid these problems most of the time. So the first thing you want to assess is, can I authenticate? Are they who they say they are? Okay, what is the still? Can I get third-party verification on who these people are? Okay, that's one. Number 2, okay, number 2 is responsible. Are they responsible? If something goes wrong, have they shown this, that if something goes wrong, let's say my account gets broken into, let's say the fund gets mismanaged, whatever goes on, if something goes wrong, have they shown a track record that they can compensate people if something goes wrong? Do they have insurance that kicks in, okay, whenever something goes wrong, so that they can pay you out? So do they have professional liability insurance? Something, but do they have some mechanism to make sure? And do they have a history? I'll give you an example in the cryptocurrency space. One of the best examples is Binance. Many cryptocurrency exchanges have melted down, okay? Binance, the reason why they're trusted. Now, I'm not saying you should go and flock your money into Binance now. There's other things you need to assess here. There's many things like, where in my wealth journey am I? What asset portfolio should I be holding? There are plenty of other factors. Let's give you an example of why out of the cryptocurrency markets, Binance has been trusted. It's because when Binance got hacked and something went wrong, Binance had an insurance policy where they paid out people whose accounts got hacked. So that's the trust factor that people are now able to have for that crypto exchange. So you just want to know that if something goes wrong, that these people are able to compensate me and my money is protected. Okay, so that's number 2 of character. Number 3 is consistency. Is what they're saying consistent with sound money principles? If you don't know sound money principles, get educated in sound money principles so that you can answer, is what these people are offering me, is it consistent with what's going on, with what is the proper foundations of money. How does money work? How does investment work? How does money get multiplied? If somebody's telling you, I'm going to quadruple your money in 24 hours, that is not consistent with sound money. Okay, it's not consistent. That's gambling. So you have to measure what they're saying. Is it consistent with sound money? If you are uneducated in sound money, go and get educated. So the first C is character, and you use the ARC to be able to assess character: authenticity, responsibility, consistency. These are the things you want to look at. Number two, in terms of the 3 C's of the 4 C's of character, of asset selection, is consistency. How many years have these people been giving out returns? How many years? Okay. So to be listed on Lucy, and this is a benchmark we use, to be listed on the Lusaka Stock Exchange, you need to have been profitable for 5 consecutive years. Okay. You need 5 years of profitability, audited financials, then you can list your company on Lusaka Stock Exchange. That is the rule, okay, to make sure that we're protecting investors and that companies who are sound are listing. That's why you can go on the quoted board first before you become listed, where people can buy your shares. So that's the process that we take whenever we're listing companies on the Lusaka Stock Exchange. So use the same method, because that protects you. Okay, for the last 5 years, have these people been issuing out financials? Ponzi schemes usually can't last 5 years. That's why after 6 months, they pack up your money and they run off with it. So 5 years is a nice benchmark to look. Ask them for 3 to 5 years of audited financials. Can I see 3 to 5 years of audited financials or annual reports of your company? Okay, then you can meet my safe and secure, because usually a lot of people cannot give you 3 to 5 years of audited financials who are asking for your money. So you want to make sure you get your money into the hands of somebody who is audited. Okay, there has to be somewhere around there. So consistency, and you need that credible consistency to be able to see the track record, because you need a track record to be able to trust where you're going. So the first C is character. The second one is consistency. How many years have they been doing this? Now, there are new products that come onto the market. People like to say, but what about new products? Anything that does not meet these 4 C's can go into what's called the experimental pile of your portfolio. The part of your portfolio you don't mind losing. Okay, whether it's 5, 10, I advise you to not exceed 15% of it. But 85% of your money that you're investing in public markets or other people using your money should be in things that tick these 4 C's. The rest, you can try out things 15% that are not in these 4 C's. So the second one, as I said, is consistency. The third one is credibility. Credibility simply means, are they telling you a credible story as to how they're going to multiply your money? Okay. If they are, does it make sense? And does it make sense is, can you tell this story to someone else? Okay. And it makes sense. It should make sense. Does it make sense? Or do you feel embarrassed when you're explaining it? So if you are confidently able to explain how these people multiply money, no, when I put my money, they multiplied it. I know that. No, but how do they do this? What is the credible story using technical knowledge? Like, what technical skill do they have to multiply your money? Whether it's in agriculture, whether it's in finance, whatever it is, but what technical skill and what are they utilizing to multiply your money? The government uses the fact that it creates money and it taxes the economy to be able to say, we are able to pay you back because of this. We are able to do that. That's the technical thing they have. They tax the economy and they're able to create money. Banks lend to other people. They lend to the government and they lend to businesses, and off that interest, they pay you your interest. So what do these people do to make money grow? A business that you invest in the stock, they go and do business activity, whether it's Copperbelt Energy, whether it's Zanaco, whatever it is, they will utilize your money in
sorry,
business activity.
Cut you short.
Pardon? But I think you're breaking right now.
Millions of minds. Of course, you mentioned about how you can look at some of the and that should also help you identify credible and trustworthy partners that you can of course invest with. But then how does authorities, I'm sure there are regulators around the very industry and business, just make scammers do not have the best of this business, because very understand how a trusted place where they can invest their monies before they even put their monies. Isn't there some regulator to help prune out these scammers in the business? Because there's a lot of money. This is not a 2,000 kind of an investment. This is not a 5,000 kind of an investment. It's a lot of money. So how are the regulators just trying to keep the environment safe?
So in fact, it's actually the fourth C actually comes down to this. The fourth C is called credentials. It actually deals with this. What regulated credentials do they have? And you must be able to ask for these things, okay? Because you should be putting your money in assets that are regulated. Stocks that are regulated, bonds are regulated. There should be some certificate of third-party regulation, because the regulator is your point of protection should something go wrong. If things are mismanaged, that's where your regulator comes in. If a unit trust mismanages money, the regulator can step in and liquidate. If a microfin mismanages money that's regulated by the Bank of Zambia, the central bank steps in, liquidates the portfolio, and makes sure that people are paid back. Now, I want people to be very careful. We do not have deposit insurance in this country yet. Okay? We do not have deposit insurance. Until we get deposit insurance, then a lot more of these things are safe. And deposit insurance is, if things go wrong, the central bank actually creates an insurance system for this. We don't have the Deposit Insurance Act, has still not been passed. It's been a bill for many years, and it's for some reason consistently sidelined. So what we need right now in this country as part of the legal reforms, especially for the investment industry, is for that Deposit Insurance Act to actually get through the books. Okay, for some reason it's been staying, and I don't know why. Even us in the media industry do not go and grill the central bank on this regularly, because when you've got deposit insurance, even some, like in America, they've got credit unions, which are their village banks. Those village banks in America have actually got deposit insurance. So should that village bank go belly up, the central bank steps in and they're able to insure that. So you want deposit insurance to now become law. So people, when you're looking for an act that needs to go through the books now, it's the Deposit Insurance Act. That has to go through, and that has to be made law, because it keeps getting written and rewritten, and a lot of you people are kept unsafe because the deposit insurance is not being pushed through. So we need to start grilling our central bank as to what's going on in that spectrum, because we've been waiting for that bill to actually be turned into an act for a long time. But so many new things keep coming up, but they always keep sidelining this one. So I don't know what's going on there. The second part I want you to focus on also when we're looking at credentials is just also to get credentials in terms of who regulates these people should something go wrong. So as I talked about, if a microfin goes wrong that's registered under the central bank can step in and liquidate it and manage it. They put it under care. They almost put it under care and maintenance to make sure that everybody can get their money. If a unit trust mismanages the money, the Securities and Exchange Commission can then step in and manage it. If an insurance company mismanages, the PIA has the authority. So you need a third-party policing service to be able to know that if something goes wrong or if something is mismanaged, you can go in there. So your 4 C's, okay, remember this, is character, okay, use the ARC to assess character, consistency. Have they got a consistent track record of being able to deliver on returns? Credibility, okay? Are they giving you a credible story as to how they're going to multiply your money? And credentials, okay? Do they have credentials with a regulator? You are making the decision. The problem I always say, Vernon, is this. People will say, no, but we need to be protected. We need to be protected. The problem is people only say that when their money has been stolen and they've been scammed. But when they're busy putting their money in there, they're not asking for government intervention. In fact, they are quiet. Okay? People are hoping to make money very quickly. So you can't, I wish there was a nicer way to say this, but you can't regulate stupidity. People like being silly. Okay. And then when they go and burn themselves, then they want you to come and wash their hands. No, you burnt yourself. You have to live with it. People have to start learning to live with the losses that they make from the decisions that they want to make, because you're adults. Okay. You're an adult. You want me to leave you alone to make your financial decisions. Because even when we talked last year, Vernon, about NAPSA and saying we should try and put some limits as to how this is used so that people are protected, so they don't, people lashed out. No, let us use our money the way we want. Leave us alone. Leave us alone. Then when they lose their money, they come and say, no, come and take care of us. So we need to, as people, start assuming responsibility for the errors that we're making financially. This is the behavior that this country exhibits. People go and burn themselves, and then they want you to come and clean up the mess afterwards. Okay, you want to gamble your money away, you want to do all these reckless things, and then when your money is gone, you want the government to step in. And I've seen this even with scammers. Even the shopping mall last year, there were people who were being interviewed last year who, when they stood in front, they said, where's the government to protect us from these illegal platforms? Was it an illegal platform when they were busy investing in it? How come nobody said, no, but this thing is not regulated? Can the government step in before something went wrong? Where were those people? Why do they only call for government intervention when they lose money? And that's where the problems come in this country. People only do that when they lose money and when they get burnt. So when it comes to public funds, so this is point number one. People, please use the 4 C's. The second point I want to make about public market investments, in other words, public investments, letting somebody else use your money, investing your money in somebody else, is please assess risk. Okay? Assess risk. Now, in the markets, risk and return move together. I want you to get this through your mind. Risk and return move together. The more I'm offering you in return on investment on your money, the more risk you are taking. So the first benchmark risk you must utilize is called the 364-day treasury bill. So look at T-bill auctions every 2 weeks. What is the rate, the interest rate or the rate of return on the 364-day treasury bill? That's called the yield. Okay, you can see that on the BOZ website. It happens every 2 weeks. There's a treasury bill auction happening this week as well. People look very carefully. Currently, that is 15% a year. So anything that is giving you a rate of return above 15% a year, that extra return, that is risk you are taking. So the more it's giving you in interest per year, the more risk you are taking. They don't tell you this, but you should know it. Okay, that is a standard way of thinking you should utilize. So anything above 15%, the 364-day treasury bill, that is risk. So if somebody's offering you 100% in a month, people, that's if you now work that out into a year, that's thousands of percent. How much higher than 15% is that? That is the amount of risk you are taking. Okay, and risk is the probability you can lose your money. That's what you need to look at. Risk is the probability in technical format. Risk is the probability your asset growth or loss can deviate from the expectation. Okay, that's what it means technically. In other words, if you expect your money to grow by 20% a year, risk is it grows by 30 or it loses by 10. What is the variation from the expectation? Okay, but when you're thinking prudently, risk is the probability you can lose your money. So the bigger the return I'm promising you, the bigger the probability you can lose your money. I want you to think like that. So everything above 15% is basically that measure. Bonds give you about 18%, 15 to 18% return on investment annually. So you know that bonds are low risk. The stock market gives you about 20 to 25%. That's already high risk, by the way. The stock market already carries quite a bit of risk. So anything above the stock market is now serious levels of risk. And you must learn to do something called risk balancing. Don't balance your portfolio of assets by the different things. Balance them by the risk. So here's a simple way of looking at it. If the stock market is 3 times riskier than the bond market, for example, okay, that's a way to look at it. The stock market is 3 times riskier, and we've done this measure over the last 22 years now. The stock market has got 2.9 times the risk than the bond market. You should not, if you want to have a balanced portfolio, in other words, equally in spread, you don't put 50% of your money in the stock market and you don't do that. That's not balancing, because the stock market is 3 times riskier. You put 3/4 of your portfolio into the bond market and 25% of your portfolio into the stock market, because you are balancing the risk. That's how you're supposed to be investing. Balance risks, not different things. No, so don't equal weight these assets in terms of the asset classes. Balance risk. So I want everyone to understand it from that way. So the bigger the return something is offering you, the less you should have of it. The temptation a lot of people have. That's why I said investing is a very counter emotional activity. You actually have to go against your emotions, because Vernon, if somebody's offering you 100% return on your investment, your temptation is to take everything you have and to dump it into that thing. But what you're not thinking about is that 100% return on investment equally comes with like a 90% chance I can lose my money. Okay, anybody who's offering you that much can actually wipe you out, like at that point. So anything that can double your money in a year can wipe you out also in a year. So what you have to understand is what you can be given can be taken, right? So always look at return on investment as a mirror of what you can lose. So the lower the return on investment you're getting, the less you also stand to lose. That's the way you have to start thinking about assets very carefully. So balance this whole situation. Yes, you must take risk, but calculate your risks properly. So assess your things by the 4 C's and assess the risk according to the risk-free rate of return, which is currently 15%. So look at what you're being offered by your village bank. Look at what you're being offered by these investment plans or whatever it is. Look at what you're being offered. Measure it against 15%. And the surplus that you are receiving above 15% is the possibility you could lose your money. That's a possibility you could lose your money. So be very careful about what you are investing in according to the risks you are taking. People, risk is real. This is why you get swindled horribly, because you are rushing into these high return instruments without assessing risk. So I just wanted to take a look at that very early today before I go into the deep conversations today. But if there's anything I want you to take out of this year, because you need to stop getting scammed. You cannot build wealth while you're rushing into scams and you're losing money in scams. You can't do that. It's not possible to do that. Okay, so you need to balance this out. Please assess risk, because even the BOZ yesterday had to give people 5 pillars of a good village bank, and I'll go through some of these things as well. The BOZ actually opened up to something called 5 pillars of a good village bank, which we'll go through at the end of this week, so that you can just touch through it and you understand it. But they did give out a nice breakdown that you're able to utilize. They also look for 5 things to look for in a money circulation scheme, just things to be able to watch out for. Now, quickly, Vernon, before we get into the main conversation about building your 8 levels of wealth, I do also quickly want to touch on just a bit of news that came out yesterday. Just a quick news announcement that came out on Reuters yesterday, that Zambia has started rationing electricity to mining firms following reduced power generation due to low levels. The chairman of the state-owned company did announce this yesterday. They did say that obviously water levels of usable power generation is 1.16%. So therefore now they have started rationing electricity to mining companies as well, not just the domestic consumers who are getting 12%. Who are getting 12 hours of load shedding staggered into 2. The mining companies will also now start getting, they said, Mr. Ngube said power rationing was expected to be reduced by the middle of next month, as water levels should start to increase and likely to resume by March. So there is the expectation that load shedding will only go on until March, not as we thought before, basically through the first 4 to 5 months of the year. The expectation is that we should be now experiencing only load shedding up to March, and we should start seeing load shedding levels. But I would like to also just maybe say this to the rest of the country: this is not the end of load shedding. You really want to make sure that you've gotten yourself off the grid, backup solutions, everything. Get things now, people, especially when load shedding stops. When load shedding stops, that's the time to buy solar equipment. That's the time to start moving yourself off the grid. That's the time to start moving to off the grid solutions, because the off the grid solutions will be cheaper when load shedding is gone. Right now, inverters, all these things, they're starting to run out and the prices are rushing through the roof because they're in demand. But on the other side of the spectrum, these things are not, when they're not in demand. When inverters are not in demand and they're not so expensive, that's when we relax too much. The time to take yourself off the grid is actually when load shedding is out of the picture, or when load shedding has reduced. That's the time to actually take yourself off the grid and to start buying off the grid solutions and to start working on off the grid solutions. So if we want a lasting resolution to this, we need to start talking about the off the grid solutions so that we can do this. Now, this extended to mining companies affects one of my top 6 stock picks of the year. Remember, I've got my mining stocks as my top 6 stock picks because of the growth of copper and cobalt. And today's news, by the way, Vernon, we've actually seen that copper is currently performing at 8,900. It's heading towards $9,000 per ton. So we're already having a copper rally because of data that's built up from because of data that has come out of China, and also the relaxation of Chinese COVID measures. Because of the relaxation of Chinese COVID measures, industry should start reopening in China again. Therefore, copper demand is starting to pick up. And with copper demand starting to pick up, we are now seeing that copper prices should start picking up as well quite strongly. So when we're looking at all this data, let's pay attention to the fact that we're having a strong copper market, which should start reflecting somewhere in the year. So if we have some good copper results, we don't want to start hamstringing our copper companies, our mining companies who should be exporting and investing because of poor power infrastructure. And this is going to be the part that's going to mess up our 3 million target by 2031 or our 2 million target by 2026, 27. For us to be able to actually now get into high levels of growth economically. So electricity is going to be a major issue. So there are 2 components to trying to make electricity more sustainable. Is one, taking as many houses off grid. That's point number 1. And number 2 is trying to see if between companies like Copperbelt Energy and these other ones, trying to get these companies to actually build their own power stations. That's something that I had stated yesterday. If you can get the independent section of the electricity market or the mining section, who consumes about 55% of the electricity, if you can get them to build their own power stations, this becomes more sustainable. So if you get the households to get off the grid and you get the mining sector in conjunction with companies like Copperbelt Energy or companies like that to start building independent power stations that are designated for mining, then the mainstream grid by ZESCO can now be to back up industries and to export. These are 2 things we can start doing, which are very good for the economy. We have a mega surplus. So if we can incentivize mines to invest in building of power infrastructure managed by CEC, and also get households to get off the grid, or at least to get the majority of their activity, be it gas geysers, gas stoves, solar geysers, those things, off the grid, you're actually freeing up about 80% of the grid for export, which becomes your biggest profitable stake in the economy. So this is a good thing if we can try and work this out into a lasting solution. Do not, when load shedding eases up, take your foot off the gas. That's the mistake everyone makes. Now, quickly, some data that we can see in the markets today as we're going through midweek readings. Egypt's CPI has gone up from 18.7% to 21.3. So Egyptian inflation has gone up. That's the data that we're picking up globally. We're also seeing that manufacturing numbers from South Africa are better than expected. So manufacturing production growth month on month is up 2%, but it's still down 1.1% in terms of year over year. So there's a little bit of a problem in South African manufacturing, but at least we're seeing the light coming up. Remember that South Africa, we import their goods. So the good manufacturing means that prices of things starts to come down. We also looked at the Red Book yesterday that came out showing that sales figures in America are up 5.3% year on year, which is down from 10.2% in the previous year, showing that the basic part, the retail sector of the U.S. economy is starting to have problems. Wholesale inventories still up 1%, and trade sale inventories are down 0.6%. So you are seeing slowdowns in the areas of trading activity and gross economic activity happening in America. While API crude numbers showed that the barrel count of America grew by 14 million barrels. So growth in barrels of oil in America has actually been very strong. In the markets, while we're also seeing that unemployment in Korea is coming up. So we are seeing that's good news for us in terms of oil prices, because more barrels of oil coming out in America means lower prices from higher supply. Data that we'll be looking at today is mortgage data is coming out of America, so that we can take a look at interest rates. We'll also be looking at crude oil data, also second round crude oil data coming out of America, while we'll be looking at CPI data and PPI data coming out of China. Chinese goods are actually becoming cheaper in the manufacturing sector with a lower Chinese currency. Remember that our second base of imports in Zambia, especially electronics, things like inverters, those things, they come from China. And with China having lower PPIs and China having a weaker currency, well, that's good for us. Because then we'll be able to import those things at a much cheaper price, getting electronics in. People, like I said, when load shedding stops, that's the time to buy this stuff. Okay, because that's when it's cheaper. It's not the time to take your foot off the gas and wait for the emergency. That's the time to start purchasing the stuff. That's a mistake we make as Zambians. We wait until the emergency and the problem to start looking for solutions instead of during the good times. The good times are where you're supposed to be now prepping for the bad times. That's what the Bible tells you. You know, Joseph said that in the Bible, where you said store up your grain, store up your grain in the good times during the good harvest, so that in the bad times you've got good grain. And that's how Joseph became the first prime minister of Egypt, because he was able to come up with that strategy of storing up during the good times, preparing for the bad times during the good times, so that when the bad times did come along, which they do at least once every odd year, you are able to be taken care of. So people don't take your foot off the gas, and this is the time to really push the alternative story. Now, as I said, we do have stronger copper, and we do have oil that's subdued below 80. The good thing is oil has stayed below 80. Copper is heading towards 40, is heading towards 9,000. That is good news for us, with gold also starting to rally. So we're getting good growth signals in industrial level. We're just not getting those signals to reflect in
All right, seems we're having a challenge there with Mutwala and his connectivity, but of course this is Behind the Markets. Remember that at exactly 8:45 we get into another segment, and of course just dwelling on that particular spectrum of a conversation this morning. For those of us who would like actually to come through and give us your take, the number, of course, is that scrolling on your screen in case you're watching live is 07716162990. Alternatively, you can still follow, of course, on our social media platforms, Twitter, Facebook, as well as Instagram. Of course, as we'll be winding up in just a couple of minutes right here on Behind the Markets. Of course, interesting, aspects that, of course, we're tackling with regards to investments and, bonds, basically, even as you, of course, are planning to venture into this particular kind of, undertaking. You understand the nitty-gritties, the in and out of how and when will be best into this kind of business at the end of the day. Mutwala, are you there?
Yes, I am back. And I've seen a comment here from Doreen Chembatembo was saying, good morning, Munyumba and Vernon. It is indeed very bad news to hear that mining will also start experiencing load shedding. This will truly affect production in the sector, knowing very well the sector is one of the main drivers of our economy. That is true. And it will affect stocks like, as we said, like CEC, Copperbelt Energy Corporation, which is one of the listed companies that we track and one of the ones that we've recommended onto my stock picks on globally. So I think it is something that we should pay attention to. And yes, that's why I said in the first half of the year, expect economic data from companies to not be that great. The job sector of the mining sector, which was already in recovery, by the way, the mining sector went from negative growth towards positive growth. Now, especially over the last 6 months, over the last 12 Over the last 6 months, we've been seeing the mining sector picking up, and also we're expecting in the fourth quarter GDP data that we're going to get stronger mining data. Probably quarter one 2023, we're going to see poor mining data as well again, and that might affect job growth in those areas, and that starts to affect salaries. It affects spending. It affects economic growth. It does. That's where the problem is coming. So you don't want to hamstring these mines at a time, and also when you're busy talking about getting to 2 million tons. You can't get to 2 million tons of copper by 2026 with poor electricity infrastructure. You can't do that. That's not going to work out as a country.
Talking about electricity, Munyumba, there are reports that the board chairperson ZESCO actually did blame for having misinformation so much that actually His Excellency even made an address about the same electricity issue. Just as we are winding up in about 30 seconds, your take on that?
Sorry, I didn't get the statement you made. Sorry, unfortunately, the line cut as you're saying that.
The actual reports that ZESCO's board chairperson actually did take responsibility for the misinformation of electricity levels, so much that actually even His Excellency had an address about the same based on their misinformation. Your take on that?
They've really managed this poorly in terms of misinformation. I'm just being honest with you. I'm surprised heads haven't rolled when it comes to ZESCO. I really am. They've really tried to blame the Zambezi River Authority. They've tried to blame everyone, but really the issue here is they have not tracked properly. And yesterday I told you the issue with ZESCO also is they want to raise tariffs. And for them to successfully raise tariffs, they need to be able to act like this was a surprise. They need load shedding. Load shedding is a weapon that ZESCO wields to raise tariffs. So they'll do anything they can. And they know that it is not legal for them to knowingly lessen power supply according to the Electricity Act. They know this. So they're playing with us and they're toying with us. That's the worst part I really have with these people, is they do this stuff in front of your face. And I always say this, Vernon, politicians and public servants, it's almost like they want to prove how, for lack of a better word, how dull we are. They really want to prove how dull we are by doing stuff in our face, and we still support them. They really have to start taking better. We really have to start holding these people authority. And I would like to start seeing Zambezi River Authority reports being published and making sure that we're speaking about them and tracking these levels on a monthly basis, the same way we do inflation data. I think in that monthly economic report that we see at ZAMSTATS, Zambezi River Authority reports should be there published for us every single month, so that we, the people, can see this and not depending on an institution whose credibility has literally tanked during this period. We can't really trust them. We need third-party data for us to be able to survive. We'll go through tomorrow, Vernon. I think we didn't manage to go through our 8 levels of wealth. We'll go through that tomorrow as we wind up today. Yeah.
Absolutely. Thank you so much. Okay, so as we will be winding up, just a quick insight on what, of course, we'll be talking about. Yesterday, we talked about how one can stay within their means. I'm sure that is something, of course, we're here to touch tomorrow.
Yeah, no, we will touch on it, but the main thing I wanted to get on, we'll touch on it about living within your means and concentrating life within your means. So my focus is getting people to invest their money that they're living within their means. So I want to make sure that people are also on wealth building trajectories. So tomorrow, what I really want to go through tomorrow is what we call the 8 levels of wealth. So it'll be the first thing that I want to touch on as you're doing your wealth building journey. Today, we've given you the 4 C's. We've told you how to assess these assets. You've got your and I just want to recap very quickly: character, consistency, credibility, credentials, and measure risk against the 15% treasury bill rate. Use the treasury bill rate as your baseline risk to know that anything above that is high risk, so that when you go out there, please know that. Tomorrow, I want to take you through your 8 levels of wealth. Where are you? Where should you be targeting over the next 5 years? And to break your life into 5-year journeys so that you know where to be going, and you have this truth of getting from where you are to getting to abundant wealth. Because that's where we want everyone to be, to have, as the Bible says, Vernon, life in abundance. As Jesus says, I come that you may have life and life in abundance. I also speak here so that you may have wealth and wealth in abundance, so that we're able now to track that journey. So tomorrow, I want to take you from insolvent to abundant wealth, the 8 levels of wealth. Very important journey, so that you know where to track yourself and what are your goals you should be setting. All right, and we'll leave that there. We'll close it out and leave that there. So thank you very much, Vernon. And as I said, we'll close that there for today.
Indeed, I appreciate. Thank you so much, Mtwale, for your time and just giving us more in depth regarding that particular aspect of a bond investment. We'll talk tomorrow. Thank you so much. Have a good one.
Cheers and have a good day.